Okay, let's unpack this. The S&P 500 just hit a brand new all-time high, smashed its previous record from February. And get this, the index, it's now up 5% year to date.
Right.
Now, that's a truly remarkable recovery, especially, when you think back, it was down over 17% year to date at its low point just back on April 7th.
Wow. Yeah.
It just feels kind of counterintuitive, doesn't it? Investing when the market seems, well, so high. What's your initial reaction to that?
It's such a classic investor dilemma, right? And if we connect this to the bigger picture, it really boils down to understanding the unique nature of stocks compared to other things we buy, other assets.
Okay.
Our consumer instincts, they scream at us to look for sales, for discounts, to buy low everywhere else.
Always look for the deal.
Exactly. But that impulse can actually be a huge misstep when it comes to the stock market. So our mission for this deep dive is really to explore why investors should maybe continue buying stocks, even when major indexes hit new highs. And crucially, why focusing on quality companies becomes especially important when valuations seem elevated like this.
That's a fascinating point because you're absolutely right. I mean, think about it. When you're buying, I don't know, a new pair of jeans or even a car, your instinct is always find a deal, buy low. We love a good sale.
We do.
So why doesn't that instinct, that buy low thing for jeans, why doesn't it quite translate to the stock market? Is it really that different?
It is. And what's fascinating here is how our everyday consumer habits can really mislead our investment decisions.
How so?
Well, most goods we buy, they're what you might call stagnant assets.
Stagnant assets, okay.
Yeah. Like a pair of jeans isn't going to magically be worth more in a few years. Unless you're talking like super rare vintage stuff. Maybe.
Right. Unlikely for my jeans.
And a car.
Yeah.
It starts losing value the moment you drive it off the lot. We all know that.
Oh, yeah. Instantly.
And even things like house prices or land values.
Yeah.
Sure, they historically increase in, say, growing urban areas, but that's mostly driven by supply and demand. More people wanting limited space. It's not because the land itself fundamentally improved or became more productive.
Okay, so you're saying you're not buying a better piece of land, just land where more people want to be.
Pretty much, yeah.
But what truly separates then a genuinely compounding stock from, I don't know, just a placeholder, or even a stock that might feel stagnant if the company isn't growing? What makes stocks so fundamentally different?
That's the crucial distinction. Stocks represent partial ownership. You own a piece of an actual company.
Right, ownership.
A living, breathing entity that's usually designed to, grow and generate profits over time.
Okay.
So even a small slice of a big growing pie can be incredibly powerful if that company compounds in value over time.
If it compounds, yeah.
And yet, investors, they still often make the mistake of thinking, oh, this stock is cheap, its price is lower, so it must be a good buy.
Or the opposite, right? It's gone up, so I should sell.
Exactly. Right. Or it's gone up, it's too expensive now, it's a bad buy. That's where our consumer brain really trips us up.
Yeah.
Because a good company can be worth more tomorrow than it is today, almost regardless of its current share price, if it just keeps compounding, keeps growing its value.
Yeah, okay. So if our normal habits are misleading us, how do we spot those businesses that are truly different? The ones that maybe justify buying even when they seem high because they are fundamentally compounding.
Yeah. How do you find them?
Let's maybe unpack an example like Visa, ticker V. That's a really well-known company, right? And it has kept going up, seemingly for the right reasons, even when it's near its all-time highs. How does that work?
Visa's a great case study. Their core business model, it's actually remained essentially the same for decades.
Decades, really?
Pretty much. But what has changed, and this is huge, is the massive global shift away from cash.
Right.
Towards debit, credit cards, digital payments, everything we use now. And Visa makes its money basically whenever its cards are tapped or swiped or the number is entered online. They earn revenue based on the sheer volume and frequency of all those transactions.
Just takes a tiny piece each time.
A tiny piece, a massive, massive pie. And crucially, Visa doesn't actually bear the credit risk. If someone doesn't pay their credit card bill.
Right, that's the bank's problem.
Exactly. Visa partners with financial institutions for that part. It's a really powerful network effect they have.
Network effect. Explain that a bit.
Sure. So as Visa's network gets bigger and more secure, more merchants feel they have to accept Visa, right? They don't want to lose sales.
Yeah, makes sense.
So they're willing to absorb Visa's fees. And at the same time, we as consumers, we're incentivized too. Purchase protection, credit card rewards.
The points.
Exactly. All those things encourage us to use the cards more. So it's a simple model, really.
Yeah.
Relatively easy to understand. And it has made patient investors very rich over time.
And you really see it in their financials, don't you? I mean, Visa has extremely high margins. They convert, what, over half of their revenue into pure profit.
It's incredible. Yeah.
The gross margin specifically is like 77.0%. That's just exceptional, huge pricing power, super efficient.
Absolutely.
And that efficiency, that's helped the stock price just soar, right? Over 400% in the last decade alone.
Phenomenal run.
And because their expenses are pretty manageable, they can pass those profits back to shareholders, not just buying back stock, but also paying a growing dividend.
That's right, returning value.
But, okay, even for a fantastic company like Visa at these all-time highs, isn't there still a risk? I mean, how do you tell the difference between a quality company that's still worth buying high and one that might just be, overvalued because everyone's excited, even if it is a quality company?
That's a great question. And that financial strength you mentioned, that's exactly what we mean by quality. And it becomes even more critical when the market's hitting all-time highs like now.
Why more critical now?
Because, well, when you're paying a premium price for a stock, you really need assurance, right? You need to be confident that the company can keep growing, keep delivering profits to justify that higher price tag.
Okay.
And honestly, only truly high-quality companies can consistently do that over the long run, which raises that important question. What makes a company actually worth a premium valuation?
Yeah.
Visa definitely commands one. Its price-to-earnings ratio, the PE, is around 35 right now.
35. So investors are paying 35 times its annual earnings per share.
Correct. And that's compared to its 10-year median PE, which is closer to 33.2. So yeah, it's trading a little bit above its historical average.
A bit rich, maybe.
Potentially. But here's the interesting part. Its forward PE, which is based on analysts' earnings estimates for the future, is lower. It's around 30.7.
Ah, okay. So the expectation is growth.
Exactly. It suggests that analysts believe Visa has the necessary qualities, the strength, to actually grow into that higher valuation over time.
Gotcha.
And this isn't just about good earnings reports. It's about a sustainable competitive advantage, what some call a moat.
A moat, right, like a castle.
Yeah, something that protects its profits from competitors, and also a clear path, a long runway for future growth. Visa's network effect, for instance, that's a powerful moat. It's incredibly hard for anyone to replicate or displace.
Okay. And just for context, you mentioned the market cap earlier.
Right, yeah. Visa's market cap is huge, around $696 billion. That's the total value of all its shares.
Wow.
And it offers a dividend yield currently of about 0.64%. So that's the annual dividend payout as a percentage of the stock price. Not massive, but it's growing.
Okay, so putting it all together, what does this really mean for you, the listener, making your own investing choices? Visa, as we said, it's just one example. There are probably many companies near all-time highs that could still be worth considering. Now, it's true, Visa stock isn't maybe the deal it was a few months back when the market dipped.
Right, not bargain bin pricing now.
But it could still be a really solid long-term investment based on what you're saying. But for someone who already follows the market, what are some common pitfalls even they might fall into when markets are this high? And how does focusing on quality really protect them beyond just liking the business?
That's exactly why being selective becomes so important when the market's at these kinds of elevated levels.
Selectivity.
Yeah. A lot of the pitfalls come from, chasing momentum, trying to get quick gains, or maybe panic selling on the first dip.
Yeah, FOMO or fear.
Right. Now, when the whole market takes a nosedive, like a rapid sell-off, that can actually be a great opportunity. That's when phenomenal companies can sometimes fall to really attractive bargain bin valuations, great entry points.
Buy the dip moments for good companies.
Yeah, exactly. But when the major indexes are already making new highs, that's when it's even more important for investors to be really selective, to only put their hard-earned savings into companies they understand well and are truly committed to holding for the long haul.
That long-term commitment.
Yes. And that commitment comes from understanding that quality. We talked about the strong balance sheet, the consistent cash flow, high returns on capital, those durable competitive advantages.
Like Visa's network effect or pricing power?
Precisely. That's what allows a company not just to grow, but to keep growing into and justifying those higher valuations over time. Helps mitigate the risk of, overpaying upfront.
So to sum it up then, The core takeaway is folks shouldn't necessarily stop investing just because stocks have gone up.
Not necessarily, no.
Instead, it's about understanding how valuation changes affect the stocks you already own, and also how price increases might change the risk and potential reward for stocks on your watch list. It's about being more discerning, more selective.
Couldn't have said it better. Be discerning. Focus on quality.
Right.
So maybe a final thought to leave you with. What stands out to you from this? Consider how this distinction we've been talking about between sort of stagnant assets like jeans or cars and compounding company ownership like stocks. How might that influence your own approach, not just to stock investing maybe, but even to other big purchases, or perhaps even how you view the long-term value of, say, skills or knowledge you acquire? Something to think about.